Well, greetings, my beloved clients and friends. So today the markets are ripping higher again because the GDP uh, numbers came in looking pretty good, better than expected, and and people feel more and more confident that the the hard landing that was feared, around the end of last year, beginning of this year, they're feeling that that's becoming less and less likely to occur. If there is a recession, it will probably be milder than what was feared. They're seeing the resilience of the consumer, and that's giving the market confidence. But I don't really want to talk about that. What I wanted to continue along kind of the theme that we talked about last time when we talked about Warren Buffett a little bit and his investment career. And he was guided to a large degree by his mentor, Benjamin Graham, who had such a profound impact on Warren Buffett that Warren Buffett named his first son after him. His first son is Howard Graham Buffett, after the two most important men in his life, his father, Howard Buffett, and his mentor, Benjamin Graham. And so Benjamin Graham was an investment manager in New York. He was also a professor at Columbia University. He wrote several books. Two of the most iconic are Security Analysis, which he wrote in the 30s. And he really laid the foundation and the groundwork for the field of security analysis as it related to equities or to stocks, because the analysis of bonds was well established by then, and he applied those same principles of bond analysis to stocks, and with great success. He wrote the book on it, and so the CFA, the Chartered Financial Analyst designation, came many years later, which was the pinnacle of our profession, to have that designation. And it was largely it was something that he was a proponent of, and many years later it finally came into existence, I believe in the 60s. And so he was a driving force of that. So the other book he wrote was called The Intelligent Investor, which was less textbooky and more for the layperson. That's the book that changed Warren Buffett's life, and it was first written, I believe, in 1949, and then every 5 years or so he'd update it. And so the last time was, I believe, 1970, and that's this one here. You see, this is what you want your financial advisor's copy of The Intelligent Investor to look like, all highlighted and earmarked, and the cover had to be taped back on because he read it so much, right? And so I taught a class on this book at the local college for 10 years. And I want to talk about this book and the two overriding principles from this book. The ones that the great investors that reverence and acknowledge Benjamin Graham, when they talk about the book and they talk about the lessons, time and again they talk about these two lessons were the most impactful and the most that changed the way of investing, and they attribute their success to the understanding and the application of these two principles. And I'm going to talk about them one at a time. one in this video and probably one in the next. And those are the two principles of margin of safety and Mr. Market. And some investors say that, you know, the two most important chapters in this book are chapter 8 and chapter 20. Chapter 8 talks about Mr. Market. The title of the chapter is The Investor and Market Fluctuations. And chapter 20 is entitled Margin of Safety. And so let me address margin of safety first. And this concept is really revolutionary and is not taught in schools to this day. And what's taught in schools is, quite frankly, you know, you ask a lot of the great investors, the ones with the best track records, and they say, man, it's wrong. Charlie Munger just comes straight out and says it. And he just laughs about what's being taught at the universities around investing. But so what is taught in the universities is this concept of a direct relationship with risk and return. So if you were to graph risk and return with risk on the x-axis and return on the y-axis, it's a positively correlated line up and to the right. Right? So they say to the higher the risk, the higher the return is what they say. But it's an oversimplification, and it could lead to erroneous conclusions. Because they're looking at historical data, and they say the reason this investment got a higher return was because they were taking on more risk. Okay, and so you graph out the risk that was taken, and the higher the risk, the higher was the return. The higher the risk going in, the higher was the return coming out. Okay. Now, when you talk about risk, the way they define it is variability of outcomes, meaning the more risk you take, the more uncertain will be your outcome. If there's very little risk, your range of outcomes will be very narrow. You think about if you take let's say a 3% CD, right? It's very low risk, and you're going to make 3%, and you're not going to make 2.5, and you're not going to make 3.5. You're going to make 3, right? So your outcome was very certain. Okay, if you look at another investment like real estate, the outcome is less certain. You don't know in the future exactly what the rent will be. You don't know exactly how much you'll sell it for. You don't know how many months of vacancy you'll have. You don't know the cost of the repairs that you'll have to do, right? So there's less certainty. So you could call that more risk, because your range of outcomes will be wider. It could do really well, and it could do not so well, right? So that's more risk. Okay, but you could assume from their graph that, well, in order to get a higher return, if that's what I want, all I need to do is take more risk. And that's not correct. If you take more risk, you might get a higher return, and on average, over many iterations, it will average out higher, but you could also get a lower return. Okay, so it's an oversimplification. It leaves out the part that the more risk you take, the bigger the chances of an unfavorable outcome. So Benjamin Graham doesn't look at risk that way. He looks at risk as not variable, possibility of outcomes, but losing money. That's the risk when you're investing, and that's the risk you want to avoid. Warren Buffett says his 2 rules of investing. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. So, and the way that Benjamin Graham proposes to manage risk is margin of safety, is the concept of margin of safety. And what does that mean? And let me go to the punchline, because when you understand margin of safety, you'll understand that margin of safety delivers return and safety, right? It gives you higher return and lower risk simultaneously. The bigger the margin of safety, the bigger the potential return and the lower the risk, right? It's not the higher return, the higher risk. The lower risk, the higher return is what he says. So how is that even possible? So let me give you an example. Let's say you're going to buy something for $10 or 10,000 or 10 million with the intention that you could sell it for 15, because you did the research and you found a place where you could buy it cheap or wholesale, and you're going to sell it retail maybe, and you think it'll sell for 15. So you say, well, that's a good business proposition. Buy it for 10, sell it for 15, make a $5 profit. So you buy it for 10. That's known. Your cost is known. The amount you sell it for is unknown. And so you try to sell it for 15, and you're not getting any buyers. So you lower it to 14, and you're still not getting any buyers. And you've already sunk $10 into it, so you lower it to 13. You're still not selling it. So you lower it to 12. Finally it sells. You were worried for a while, but hey, you had a 20% profit. You're pretty happy with that, even though it wasn't what you expected. You said, you know what? Okay, it wasn't 15, but it was 12, and that's good enough to do it again. And so you did it again. You went and bought it for 10, you tried to sell it for 15, it didn't go. You said, I'm not worried about that. I know if I wait, I can sell it for 12. Well, you lower it to 12 and you still can't sell it. And now you need to pull your cash out, and you lower it to 10, you still can't sell it. But you need to get a return on your investment, so you lower it to 8 and finally it sells. So you bought it for 10, you sold it for 8. So you had 2 operations. You bought for 10 and 10, so your cost was 20. You sold for 12 and 8, and your return was 20. All you did was break even. And you're like, well, that was a lot of work for not any return. But you kind of like the concept, and you're just searching around on Google, and you realize that, hey, I could buy this thing for 5 in China. And even if I sell it for 15, that's huge. Even if I sell it for 12, it's still great. Even if I sell it for 8, I'm still making decent money. So you're back at it. And sure enough, when you buy it for 5, things start working out, because sometimes you sell it for 12, sometimes you sell it for 8, and on average you end up selling it for 10, and you make a really nice return. So if you look at those 2 scenarios, the one where you were buying it for 10 and being hit and miss, and the one where you were buying it for 5 and consistently making money, what was the difference between buying it for 10 and buying it for 5? Well, Benjamin Graham would call that a margin of safety, right? You had a bigger margin of safety when you were buying it for 5. Buying it for 5 lowered your risk, and buying it for 5 instead of 10 increased your return. right? Because you found a bigger margin of safety, right? Simultaneously increasing your return and lowering your risk. That is the concept of margin of safety. And it makes much more sense than that risk return paradigm that is taught in schools. And so when we see a good company go down in price, it's an opportunity because at that new lower price, it represents a bigger margin of safety. And when we see a good company go way up in price, and maybe we've had a nice return on it, continuing to hold it at that higher price, we don't have that big of a margin of safety as when we originally bought it, right? So it's more concerning, right? So sometimes, that's why Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. When everybody's making money and they're all happy, that's when that value investor is kind of looking around over his shoulder and really uncomfortable because things are uncomfortably high, and he understands that there's very little margin of safety in what he owns. And when other people are panicking and fearful, that value investor gets excited because he realized the margin of safety is getting bigger and bigger, and it represents a bigger opportunity. So it's a fundamentally radically different way of thinking of investing, and when applied correctly and consistently, it's a method that actually lowers your risk while increasing your return. So we try to apply that as much as possible and consider the margin of safety of the investments that we want to consider buying and the ones that we already own. Okay, so that's a brief summary of the concept of margin of safety. Next, we'll talk about Mr. Market, and hopefully that gives you some insight and help and understanding of why we do some things that we do. All right, so have a wonderful day.